There are three cyclical themes that PIMCO has identified that are critical in driving markets today. First and foremost would be conflict in the Middle East and war with Iran that has in the near term created an inflationary narrative in marketplaces, which has led to flatter yield curves, slightly higher interest rates, and a repricing of expectations for central bank policy paths throughout 2026. The longer term potential implication is one of demand destruction from higher energy prices, lower disposable income, and the negative economic impact and shock that might come later in the year. The second key cyclical theme from the first quarter of 2026 is one of disruption in private credit markets, which is going to be a long theme to work out. Credit fundamentals are deteriorating, and we expect that to have a longer term impact on credit creation and the lending environment more broadly. The third theme is a transition really in artificial intelligence and technology from a tailwind that has created a very resilient economic environment from capital expenditure and investment spending to one of disruption and turmoil and risk of company failure. How should portfolios be positioned given an outlook for higher inflation and slower growth? It's a difficult question to answer. Stagflationary environments are often difficult for investors to face. And so perhaps the right way to think about this is now and then. Now be concerned about the risks of higher inflation, then be concerned about deteriorating economic activity. In order to manage this type of environment, PIMCO has several thoughts or pieces of advice for investors that we try to instill within our portfolio managers. Focus on resiliency. Focus on higher quality portfolios. Second would be treat liquidity as an asset. During volatile periods, if investors have liquidity, it is possible to pivot and capitalize on opportunity rather than feel stuck with an existing portfolio, to be able to think in a counter-cyclical manner rather than a pro-cyclical manner. And the third is the time-tested investment advice, which is focus on diversification and run diversified portfolios that allow investors to rebalance again during times of stress or periods of volatility.